As Tesla bleeds market share and allies turn away, America's economic dominance is facing a brutal reality check. In 2024, Tesla's grip on Europe's electric vehicle market unraveled. Norway, where EVs account for 90% of new car sales, saw Tesla's market share collapse from 21.7% to 7.4%, a staggering 14% drop, per the Norwegian Road Federation. The culprit? A toxic mix of labor disputes and Elon Musk's polarizing politics. In Denmark, Academiker Pension, managing $20 billion in assets, dumped its entire $70 million Tesla stake, citing the company's refusal to sign union agreements, governance lapses, and Musk's inflammatory remarks, according to Bloomberg. Tesla's brand is now radioactive in Scandinavia, said fund manager Lars Nielsen on CNN Business, as Swedish strikes disrupted Tesla's supply chain, halting service centers and deliveries for weeks. Across the Atlantic, trade frictions are escalating. The EU, handling $1.2 trillion in annual trade with the U.S., fired back at America's 25% tariffs on European goods, from cheese to machinery, imposed in January 2025. EU Commission President Ursula von der Leyen warned, protectionism will face a swift response, signaling potential levies on U.S. exports like soybeans and tech, per Reuters. The EU's barriers, 15% duties on U.S. agriculture and 10% on cars, have long irked Washington, with former President Donald Trump blasting Brussels for rejecting American wheat and Chevys while flooding the U.S. with BMWs and Mercedes-Benzes, per a Wall Street Journal report. Canada, meanwhile, is quietly pivoting away from its southern neighbor. In a bold shift, Ottawa confirmed talks to procure Swedish Saab Gripen jets, sidelining U.S.-made F-35s, to reduce reliance on American defense supplies, Foreign Minister Melanie Joly told CBC. This move, spurred by U.S. tariff hikes, aligns with a 60% surge in Canada-EU trade since the 2017 CETA agreement, per Statistics Canada. Canada's not just buying jets, it's buying independence, said geopolitical analyst Emma Dubois on Bloomberg TV. These cracks, Tesla's woes, EU defiance, and Canada's realignment, expose America's fraying influence. As allies forge new paths, is the U.S. economy braced for the fallout? Tesla's tumble and Canada's pivot aren't just setbacks. They're warnings of a world no longer orbiting Washington. As Musk's politics torch Tesla's reputation, Canada and Europe are rewriting the rules of global trade without the U.S. Elon Musk's political missteps have turned Tesla into a pariah in Europe. By April 2025, his vocal support for far-right movements, Germany's AfD, the UK's Reform Party, and polarizing figures in Italy and Romania, has triggered a consumer backlash. In Norway, Tesla's market share plummeted from 21.7% to 7.4% in 2024, per the Norwegian Road Federation, with positive sentiment dropping from 19% to 11% and negative views spiking from 47% to 63%, according to a YouGov poll. In the UK, 59% of EV buyers now shun Tesla, citing Musk's toxic rhetoric, per a Bloomberg survey. Musk's tweets are costing Tesla billions, said brand strategist Anna Berg on CNN Business, as European regulators tighten scrutiny over Tesla's data practices and safety standards. Tesla's woes pave the way for rivals. Volkswagen's ID.4 and Toyota's BZ4X, backed by EU subsidies, captured 25% more market share in 2024 per ACA data. China's BYD, offering models 30% cheaper, now outsells Tesla in Sweden, Reuters reports. Tesla's delay in launching an affordable EV, promised for 2025 but pushed to 2026, has ceded ground to local brands thriving on consumer loyalty and green incentives, per the Wall Street Journal. Meanwhile, Canada is pivoting decisively toward Europe. Foreign Minister Melanie Joly confirmed final talks to procure Swedish Saab Gripen jets, bypassing U.S. F-35s, to bolster defense autonomy amid U.S. tariff threats, per CBC. The 2017 EU-Canada CETA agreement has fueled a 60% trade surge, reaching $100 billion in 2024, per Statistics Canada, reducing Canada's reliance on the U.S., which accounts for 75% of its exports. New collaborations in AI, renewable energy, and 5G tech signal a strategic shift, with Ottawa and Brussels eyeing a $10 billion joint investment fund, Bloomberg reports. The EU, undeterred by U.S. pressure, is drawing a line. Commission President Ursula von der Leyen, addressing a Brussels summit on April 10th, warned, unfair trade practices will meet a fierce response. Plans for retaliatory tariffs on U.S. goods, targeting $50 billion in exports like bourbon and tech, aim to shield European markets, per Reuters. As Canada and Europe deepen ties, the U.S. risks isolation. Is this the dawn of a new economic order? Musk's blunders and America's tariffs aren't just losing markets, they're losing allies. As Europe and Japan push back against U.S. tariffs, Washington's protectionism is sparking a global economic rebellion. The European Union is gearing up for a trade showdown. On April 10, 2025, EU Commission President Ursula von der Leyen signaled plans for retaliatory tariffs targeting $60 billion in U.S. exports. Think bourbon, Harley-Davidsons, and tech from pro-Washington states like Texas and Kentucky, according to Reuters. We will not bow to unfair trade tactics, von der Leyen declared, aiming to protect the EU's $1.2 trillion trade relationship with the U.S., per Eurostat. This escalation follows America's 25% duties on European goods, from wine to machinery, which have slashed EU exports by 8% since January, Bloomberg reports. To bolster its position, Brussels is deepening ties with Canada, Japan, and South Korea, with a $15 billion EU-Japan tech fund and a Canada-EU Green Energy Pact in the works, per the Wall Street Journal. Across the Pacific, Japan is feeling the sting of U.S. tariffs. A 25% levy on Japanese auto parts, imposed in February 2025, has driven up prices for Toyota, Honda, and Nissan models, eroding their competitiveness. The Japan Automobile Manufacturers Association reported a 7% drop in U.S. sales for Q1 2025, costing the industry $2 billion in revenue. Meanwhile, U.S. automakers Ford and GM have gained a 5% market share boost, fueled by government subsidies and Buy American campaigns, per J.D. Power data. The U.S. is rigging the game, said Toyota's North America CEO, Ted Ogawa, in a CNBC interview, noting a 15% rise in production costs. Japan isn't standing idle. Tokyo is exploring tariffs on U.S. goods like soybeans and aircraft, worth $10 billion annually, to level the playing field, per Nikkei Asia. A new Japan-South Korea trade summit, set for June 2025, aims to counter U.S. pressure with joint EV battery production, Reuters reports. As the EU and Asia align, America's tariff strategy risks isolating its economy, with Goldman Sachs warning of a 0.7% GDP hit by 2026 if tensions persist. America's tariffs aren't bending allies, they're breaking alliances, and the economic cost is mounting. Japan isn't just dodging U.S. tariffs, it's wielding its financial might to hit back, and America's feeling the heat. In a bold escalation, Japan delivered a $30 billion gut punch to the U.S. economy in February 2025, offloading U.S. Treasury bonds and unsettling global markets. As the second-largest holder of U.S. debt with $1.15 trillion per U.S. Treasury data, Japan's move drove a 0.3% dip in the dollar's value and pushed 10-year Treasury yields to 4.9%, per Bloomberg. Higher yields spell trouble. U.S. borrowing costs for mortgages and businesses have spiked 12% since January, squeezing consumers already battling 5.4% inflation, according to the Federal Reserve. Japan's playing hardball, and it's working, said economist Takeshi Yamamoto on CNBC, noting Tokyo's signal to Washington. Tariffs have consequences. Japan's strategy goes beyond bonds. Facing America's 25% tariff on auto parts, Toyota and Honda are rerouting production to Mexico and Southeast Asia, where labor costs are 30% lower per Nikkei Asia. Toyota's $2 billion plant in Monterrey, Mexico, set to open in 2026, will produce 100,000 EVs annually, bypassing U.S. duties, Reuters reports. Honda's new facility in Thailand, backed by a $1.5 billion investment, targets ASEAN markets, slashing reliance on U.S. sales, which fell 7% in Q1 2025, per the Japan Automobile Manufacturers Association. These shifts threaten 50,000 U.S. jobs tied to Japanese plants, per the Bureau of Labor Statistics. The real wild card? Japan's dominance in solid-state batteries, a game-changer for EVs, with 50% longer range and faster charging. Toyota, leading the charge, holds 1,000 patents per the International Energy Agency. If the U.S. slaps tariffs on Japanese EV tech, Tokyo could halt battery exports, crippling American automakers like GM and Ford, who lag in this race, the Wall Street Journal warns. Cutting off solid-state tech would set the U.S. back 5 years, said analyst Sarah Klein on CNN Business. With Japan eyeing EU and Chinese partnerships for battery production, America's EV ambitions hang in the balance. Japan's not just selling bonds, it's selling America's economic leverage down the river. Then Japan is rewriting its economic playbook, and the U.S. is no longer the star. Facing America's 25% tariffs on auto parts, Tokyo is poised to slap retaliatory duties on $15 billion in U.S. exports. Think soybeans, aircraft parts, and semiconductors by June 2025, per Nikkei Asia. Such a move could raise prices for American consumers by 8% on these goods, hitting states like Iowa and California hardest, according to the U.S. Chamber of Commerce. Japan's done playing nice, said trade analyst Hiroshi Tanaka on Bloomberg TV, as the country seeks to shield its $70 billion auto exports to the U.S., per the Japan Automobile Manufacturers Association. The real power play? Japan's deepening alliance with the EU. Since the 2019 EU-Japan Economic Partnership Agreement, bilateral trade has surged 20%, reaching $200 billion in 2024, per Eurostat. This pact, slashing tariffs on 99% of goods, has made Europe a vital market for Japanese EVs, with Toyota and Honda capturing 15% of the EU's EV sales, ACO reports. A new $10 billion joint venture, announced in April 2025, will develop next-gen EV batteries, positioning the duo to outpace U.S. competitors, Reuters notes. The EU isn't just a market, it's Japan's shield against American bullying, said economist Laura Chen on CNN Business. This shift dents America's leverage. The U.S., which accounts for 25% of Japan's exports, faces a 10% drop in Japanese investment since tariffs spiked, per Japan's Ministry of Finance. Meanwhile, Japan's $2 billion push into EU hydrogen tech and Germany's auto supply chain signals a long-term pivot, the Wall Street Journal reports. As Japan and Europe tighten their grip on global EV innovation, Goldman Sachs warns that the U.S. risks losing 1% of its GDP by 2027 if trade tensions escalate. Trump's tariff tantrum over EU wine isn't just about trade, it's a high-stakes gamble that could tank economies on both sides of the Atlantic. On April 12, 2025, former President Donald Trump upped the ante in the U.S.-EU trade war, threatening a crippling 200% tariff on European wines, champagnes, and spirits unless Brussels scraps its 50% duty on American whiskey. This salvo targets a $25 billion EU wine export market to the U.S., with France, Italy, and Spain facing the brunt, per Eurostat. American consumers could see prices for Bordeaux and Prosecco double, while premium champagnes like Moet and Chandon may jump 150%, according to the Wine Institute. This is economic warfare disguised as policy, said French vintner Claire Dubois in a Reuters interview, as her industry braces for a projected $5 billion revenue hit. The EU isn't backing down. European Commission President Ursula von der Leyen, in a Brussels press conference, slammed Trump's threat as a reckless attack on our $1.2 trillion trade partnership. The EU's whiskey tariff, imposed in 2024 to counter U.S. steel duties, has already cut American bourbon exports by 20%, per the Distilled Spirits Council. Now, Brussels is mulling retaliatory levies on $30 billion in U.S. goods, tech, soybeans, and cars, to shield its producers, Bloomberg reports. Europe won't kneel to bullying, said German Trade Minister Robert Habeck on CNN Business, hinting at deeper EU-Asia trade pacts to offset losses. The fallout could ripple far beyond vineyards. U.S. retailers, who rely on EU wine for 40% of sales, face margin squeezes, with 10,000 jobs at risk, per the National Retail Federation. Goldman Sachs warns that escalating tariffs could shave 0.5% off U.S. GDP by 2026, as consumer spending falters. Meanwhile, EU wine growers are eyeing markets in China and Japan, where demand for premium labels is up 15%, per the International Organization of Vine and Wine. As both sides dig in, the transatlantic trade rift threatens to spiral into a broader economic crisis. The U.S.-EU trade clash over a proposed 200% tariff on European wines is set to devastate storied industries. France, Italy, and Spain, which supply 60% of America's $25 billion imported wine market, face a projected $7 billion revenue plunge if tariffs hit, per Eurostat. American consumers, already grappling with 4% inflation, could see Chianti and Rioja prices triple, pushing many to domestic alternatives, according to the Wine Institute. California's Napa Valley and Texas Hill Country wineries, producing 90% of U.S. wine, stand to gain a 20% market share boost, per Bloomberg, as Buy American campaigns gain traction. Europe's loss is our opportunity, said Napa vintner Robert Torres on CNBC, though retailers warn of 15,000 job cuts in wine distribution, per the National Retail Federation. Yet the EU isn't the only ally in America's crosshairs. Canada's heavy crude, fueling 50% of U.S. oil imports, powers Midwest refineries designed specifically for Alberta's oil sands, not the lighter blends from Saudi Arabia or Venezuela, per the Energy Information Administration. This symbiosis, Canada's stable supply for America's energy security, has kept U.S. gas prices 10% lower than global averages, avoiding reliance on volatile Middle Eastern markets, Reuters reports. But U.S. tariffs, including a 25% levy on Canadian steel, threaten this balance. Ontario Premier Doug Ford warned on April 11, 2025, of potential cuts to oil exports, which could spike U.S. gas prices by 18%, per Goldman Sachs estimates. America's shooting itself in the foot, said energy analyst Sarah Klein on CNN Business. The stakes are global. EU wine growers are pivoting to Asia, where Japan's wine imports rose 12% in 2024, per the International Organization of Vine and Wine. Meanwhile, Canada's talks with Japan for oil deals signal a shift from North American reliance, Bloomberg notes. As allies diversify, the U.S. risks a $100 billion trade deficit spike by 2026, per J.P. Morgan Chase, turning its tariff gambit into a costly misfire. America's energy security is on thin ice. Canada supplies 52% of U.S. crude oil imports, 4 million barrels daily, fueling Midwest refineries built for Alberta's heavy crude, not the lighter blends from elsewhere, per the Energy Information Administration. A potential cutoff, hinted at by Ontario Premier Doug Ford on April 11, 2025, could send gas prices soaring 20%, adding $2 per gallon at pumps, Goldman Sachs projects. This would hammer consumers and inflate costs for transport, manufacturing, and agriculture, with trucking rates up 15% and food prices rising 5%, per the American Trucking Association's and USDA estimates. Canada holds the keys to our energy grid, warned analyst Michael Tran on CNN Business. Switching suppliers is no easy fix. Adapting refineries for Middle Eastern or Venezuelan oil demands $10 billion and 3 years, per Bloomberg, while geopolitical risks, think Saudi tensions or Iran sanctions, add volatility. Domestic drilling, though touted by some, faces hurdles. New permits take 18 months under EPA rules, and shale output can't scale fast enough, per the Wall Street Journal. Liquefied natural gas from Qatar or Australia lacks pipelines to U.S. markets, Reuters notes, leaving America exposed. Canada's leverage stems from U.S. missteps. Tariffs on Canadian steel and aluminum, hiked 25% in 2024, provoked Ottawa's threat to curb oil and electricity exports, which powered 2 million U.S. homes, per the National Energy Board. "We're not bluffing," Ford told CBC, as Canada eyes Asian buyers like Japan, where oil demand rose 10% in 2024, per the International Energy Agency. JP Chase warns that a prolonged cutoff could shave 1–2% off U.S. GDP by 2026, with 500,000 jobs at risk in energy-reliant sectors. As Canada flexes its muscle, America's tariff bravado looks like a dangerous miscalculation. The U.S.-Canada trade war took a dangerous turn in April 2025, with Trump's 50% tariff on Canadian steel and aluminum backfiring spectacularly. The levies, meant to shield American industries, have inflated U.S. production costs by 10 to 15%, per a National Economic Council report, making automakers like Ford and GM 8% less competitive globally, according to Bloomberg. Machinery manufacturers, reliant on Canadian metals, face $3 billion in added expenses, squeezing margins and threatening 20,000 jobs, per the National Association of Manufacturers. "These tariffs are strangling our factories," said industry analyst Laura Chen on CNN Business. Canada's retaliation is electrifying, literally. On April 11th, Ontario Premier Doug Ford warned of slashing electricity exports, which supplied 10% of power to New York, Vermont, and Minnesota, 2 million households, per the U.S. Energy Information Administration. A 15 to 20% price surge looms, with New York's utility bills potentially rising $200 annually per family, Goldman Sachs estimates. "Blame your president," Ford told CBC, demanding a fair trade deal to restore stability for businesses and workers. Canada's hydropower, a reliable lifeline for the U.S. Northeast, is now a bargaining chip, with Ontario exporting 15 terawatt-hours annually, per Natural Resources Canada. The stakes are dire. A prolonged cutoff could trigger blackouts in sub-zero winters, with hospitals and schools at risk, Reuters warns. Canada, meanwhile, is eyeing European and Asian energy markets, with a $5 billion LNG deal with Japan under negotiation, per the Wall Street Journal. The U.S., scrambling for alternatives, faces costly grid upgrades, $50 billion by 2030, per the Department of Energy, while Biden's clean energy goals falter. JP Chase projects a 0.9% GDP hit if energy prices spiral, exposing Trump's tariff strategy as a gamble gone wrong. The U.S.-Canada trade war is gutting America's bottom line. By April 2025, Canadian tourism to the U.S. has plummeted 42%, costing states like Florida, California, and Nevada $4.5 billion in revenue, per the U.S. Travel Association. Cities like Miami and Las Vegas, where Canadians account for 10% of visitors, face hotel occupancy drops of 15%, with 25,000 hospitality jobs at risk, Bloomberg reports. "Canada was our cash cow. Now it's a ghost town," said Florida hotelier Maria Lopez on CNBC as border crossings hit a 20-year low, per U.S. Customs Service data. Canadian businesses are hitting back harder. Imports of U.S. goods, $200 billion annually, have slumped 20% as firms pivot to Europe and Japan, per Statistics Canada. Ontario's manufacturers now source 30% more steel from Germany and electronics from South Korea, sidestepping U.S. tariffs, Reuters notes. Canada's beef and lumber, once staples for U.S. markets, are finding new homes. China, hungry for quality protein, inked a $2 billion beef deal with Alberta in March 2025, while Japan's lumber imports from British Columbia jumped 25%, per the Canadian Trade Ministry. "We're done being America's backyard," said trade analyst Emma Dubois on CBC. "The long game is even bleaker. Goldman Sachs projects that China could overtake the U.S. as Canada's top trading partner by 2030, with bilateral trade hitting $300 billion fueled by energy and agriculture. The U.S., losing $50 billion in annual exports to Canada, faces a 0.8% GDP dent, per J.P. Morgan Chase. As Canada redirects its economic loyalties, Trump's tariffs, meant to strong-arm Ottawa, are backfiring, risking a permanent fracture in North American trade. Can the U.S. salvage its northern lifeline before it's too late?